All right, I think we're good to go. Also from my side, a very warm welcome here on AirMeet, a new platform that we now use for the meetups. Gives us a bit more flexibility in terms of networking. So later on we will have time where you can meet at virtual tables. My talk today are financial markets predictable and machine learning perspective. I'm not going to give you an answer, so this up front. This also says your work in progress, and for me it's more like a research agenda, if you like. It's more like a framework to discuss the question. If we will be able to predict financial markets with a certain accuracy, well above 50%, I think we would all be very, very rich and probably would not talk about it in detail. But at least I want to provide you with a framework. Also to Jason, thanks very much for providing context. We've seen that Python indeed seems to be a proper language, and today the language of choice to analyze such questions here in this context. Before I dive in, maybe a very quick look at a few slides here with regard to the Python fonts. I don't want to get into that. If you're interested in what we do, just tpq.io, all around Python for Finance, the AI machine. It's our trading platform project, so for algorithmic AI-powered trading, right? And a few informational points I just want to highlight, not what I've been doing, but the middle part, maybe, because Jason said it, I have published a few more books, and this is the only point that I want to highlight. So that's the newest one. I just, like 2 days ago or 3 days ago, I received the print copies of this book. It's a smaller book. It's an introductory book. It basically starts before all my other books start. So back in the days when the first edition of Python for Finance was published, people say, well, this doesn't really teach Python. It also doesn't really teach finance, and it was never meant to do that. It's more like a reference work, Python for Finance, at the intersection of the two topics. And here, this is like a book that teaches from ground up, from scratch, financial theory by the use of Python. Of course, there's a little bit of mathematics involved, so these three elements, but it's not involved, complex, complicated. Therefore, here the subtitle, a gentle introduction, right? Risk return, pricing of instruments, expected utility theory, mean variance portfolio theory, the standard financial, traditional financial models and theoretical ideas are presented here and introduced and illustrated by the use of, I would say, relatively simple Python concepts. In particular, NumPy is used, so NumPy throughout, right? SciPy for optimization, right? That's what we need there. But again, on a fundamental level, if you say, well, I'm doing Python for Finance since 10 years, this is probably not the book. If you say, well, I want to get into the domain, that might be your starting point, right? Here's Python for Finance in the second edition. This has been translated into quite a few languages, Chinese, Japanese, you see here, and a few more. That's like a large book, 710 pages. The other one, the introductory one, here is just 200 pages. It's basically the smallest, the shortest book I've ever written. These are the books that I've published last year. So during the lockdown, I had quite a bit of time because I wasn't traveling that much, obviously, like everybody else. And I was able to finish and publish 2 books, Python for Algo Trading, from idea to deployment, and AI in Finance, which also focuses mostly on the topic of today, market prediction, and algo trading is the canonical example in this context. These are my Quant Finance books. And with that, I want to get to my talk. But my financial theory Python, the brand new one, this is what I wanted to highlight. So, are financial markets predictable? Let's have a look at the agenda. I first want to define predictability in a sense of that we could come up probably with a bunch of different definitions. So I want to provide a very simple one. Then I want to address the question, why does it matter? Some prediction methods which people have come up with in the past, correlation versus causation. So I don't know whether our meetup groups have pushed Python in the domain a bit more. So if this was like causation, or if it was just like en vogue to meet and to discuss Python in our domain. A little bit of finance history, so related to a large extent to my new book. And out of that, efficient markets are kind of like important, because if markets are efficient, if the random walk hypothesis holds true, then they are not predictable. That's the major insight. And for algo traders, for day traders, right, the efficient market hypothesis is the villain, right? It's the enemy in this context. Because again, if markets are efficient, then it's difficult, if not impossible, to make abnormal superior profits as compared to passive investing, which I want to also touch upon briefly. Math and science, that's more, again, framework-oriented discussion here, because I think finance, similar to physics, suffers a bit from the beauty myth. And we would see that maybe other approaches that we these days have available, like using lots and lots of data and artificial intelligence and machine learning, these are the final 3 points here, are maybe a bit better than simple math, right? Maybe finance is not like physics where you have E equals mc squared and this provides us with the truth. Maybe there is no such truth, right, for finance. All right, predictability defined. Let's get started with definition of time. 0 is kind of like the current point in time, and -1 would be yesterday, +1 would be tomorrow. So very simple setup. It could also be now, 1 minute later, and 1 minute before, or 5 minutes. So just think in terms of bars, where the bar length can be flexible in that sense. Usually we think of homogeneous time intervals, but even heterogeneous time intervals in this context would fit into the description. So PT is the price of a financial instrument at time t, right? We have a current price, let's say the Apple stock price currently. We have yesterday's price, so the financial history, and the problem might be, this is what we are concerned here with, to predict the future price tomorrow. Usually we think one step ahead, but of course there could be setups where we think 1 week ahead, 1 month ahead, etc. Therefore, it's not the only definition that I provide here that fits the description of predictability. Or for short, we simply say P0, P1, etc. That's the starting point. So from Wikipedia, here the definition of a Markov chain or Markov process, stochastic model describing a sequence of possible events in which the probability of each event depends only on the state attained in the previous event. So in that sense, if we have efficient markets, processes should be Markovian, because the whole history simply doesn't matter for the distribution of the future returns, right? So the distribution of the price PT only depends on PT -1. For a non-Markovian process, the distribution of PT can depend on the history of the prices, right? Depending on how we define it, we can have a long history, short history. So here I only write out like the 3 most previous price points, right? But we could go 30, 300, whatever. But typically we have like a fixed window that we look back and say, well, let's see whether we can read out something, whether we can spot patterns, right? Machine learning, pattern recognition that allow us to come up with predictions of the future price. But Markovian processes are important. They are related directly to efficient markets, and the random walk, for example, the Brownian motion is a Markovian process. So to simplify things, we are in general not really concerned with the absolute price, with the price change itself, but rather with the direction of the change in price. So what we would say DT, direction, is +1 if we have a positive change, or 0. I intentionally set it here to 0. Later on in applications, I would rather use -1. So +1 for the market goes up, -1 for the market goes down. But for example, when you put something like this, like binary labels, into a TensorFlow context, you would need to have it here as 0s and 1s. But again, with Scikit-Learn, for example, later, we can go with +1 and -1. So that's the basic idea. Direction, not necessarily the price itself, which is a pretty hard thing to do. So this gives the process of directional changes, right? Up, down, down, up, down, whatever. So the problem we want to focus on is now whether we can predict the future directional change. When we know the history of changes, again, this is just like a working definition. There could be many others that we could come up with, and taking into account 5 historical directional changes, a total of 2 to the power of 5, we get 32 patterns. So pattern recognition, right? Machine learning, supervised learning, we have only 32 patterns. Something that we as human beings might even be able to master, right? When we later on I have a chart, when we think in terms of technical patterns, usually people maybe trade 3, 5, 7, maybe 10 technical patterns. Right here we have just 32 and they are pretty simple. You see here based on random numbers, like one pattern 0, 0, 0, 1, 0. This is by chance the same, so we have so few patterns here. I didn't fix the seed here, so by chance we got here the same pattern. So I can execute this a couple of times, right? And you see that we always get a different, not always get a different pattern, but we would expect a different pattern here. So this now is 1, 1, 1, 0, 1. Just another pattern, and you have seen now quite a few when I was executing this Python code cell and was redrawing the random integers here, giving us one of 32 possible patterns. So now we're interested by whatever means in estimating probabilities for d1 equals 1 and or d1 equals 0 for any historical pattern. So we go back here 5 days up until now. So when we have a look at, I don't know, the Refinitiv workspace, Bloomberg terminal, right, we can read the current price, we can read yesterday's price, but for sure not the future price tomorrow. And we can of course also easily derive directional changes. And usually machine learning algorithms, or we ourselves, we want to form conditional probabilities. So given a certain history, given one specific pattern, we are interested in the probability for the market going up or the market going down. So when I talk about market, it could be a stock price, could be an index, could be a currency pair, could be Bitcoin to this end, right? So any financial instrument that is traded and quoted in that way. So such a problem is typically called the binary classification problem, right? So internally probabilities, but as results, a machine learning algorithm given one of these patterns would give us up or down here in the form of 1 or 0, later 1 or -1. So one of two classes only need to be picked. So the one is to be picked for which the higher probability is estimated. Classification is a special type of pattern recognition and also falls in the category of supervised learning algorithms in machine learning. And we are in the world of machine learning already with this context. So predictability now is a degree to which a correct prediction or forecast of a system state can be made, either qualitatively or quantitatively. And let's go with the quantitative side. And what typically is chosen as a measure for predictability is the accuracy, which is one metric for evaluating classification models. Informally, the accuracy is the fraction of predictions our model got correct, right? We might be making 10 predictions, and if 6 are correct, we have an accuracy of 60%. Here we see it formally defined. Accuracy, number of correct predictions over number of all predictions. So we would now say that a process of directional price change is predictable if the accuracy of the prediction is significantly higher than 50%. So I'm not going here with a specific number, but usually we would expect at least 50 plus X%. Sometimes 50.9 would be good. Sometimes we might require 55%. It would be good to have maybe 60, 70%, right? But that's usually not possible. And I'm also not going with a specific number because it's not only relevant how many correct predictions an algorithm can come up with in terms of the accuracy. It's also relevant, absolutely relevant, which changes are predicted correctly. So the large moves, these are the ones that we want to predict correctly. Primarily, very small moves around 0, tiny bit above, tiny bit below 0. Might be nice to get them correct, but usually in terms of the financial impact, they are usually not relevant, or not as relevant at least as the much bigger moves that we see, like a tail move in a distribution. So why does it matter at all? To be able to consistently well predict financial prices or directional changes in financial markets can be considered the holy grail. I don't know how many people around the world, maybe we should do a poll in this regard, are trying to do this. Not everybody, of course, right? Many people who believe simply in the efficient market hypothesis and invest their, let's say, retirement savings in ETFs passively, right? That's perfectly fine. But there are for sure quite a few people who try it. Why is this the holy grail? Yeah, plain simple, because it would be a sure path to tremendous riches. A simulation analysis with real-world data should illustrate my point here. So I'm working with a certain data set which accompanies or which is used intensively in my book AI in Finance. I'm not going through the details, just like to get a feel for what is at stake here in this context. I go with the euro yes dollar. I'm now defining different strategies. A bull strategy is simply going long and doing nothing. Right, that's one thing. I start here in 2015. The data set ends at the end of 2019. So 5 years, right? So I have long only. Then I have a completely random strategy, right? Like flipping a coin and saying the next day long. Flipping a coin again, next day short. Flipping a coin, stay short, for example. So that's the random strategy. And then the opposite of the bullish one, the long, is the short one. It's the bearish one. So these are three simple benchmarks that we can always define. Long only, short only, or flip of a coin every day to change the position, to do trading, right? So now we assume a bit more sophisticated, I would say, as compared to the benchmark, that the top 10% of both the positive and negative movements, days in this context, right, end of day data, are correct. So the top 10% of positive moves and the top 10% of negative moves, or the bottom 10%, depending on how you would define and sort it, are correctly predicted, or the top and bottom 15%. So for the rest, we have a random strategy. So I'm not saying top 10, bottom 10, and the rest is absolutely false. So I go here with the rest always as a random strategy. It's synthetic, it's sandbox, it's more or less arbitrary here, but this is to make the point. A bit of code, and for 10% and 15%, we get the numbers calculated. Now the ratio, where we say, well, 50% always correct, or 51 here I get started with, and the rest again random. So I basically say that here with the 0.6, that 60% upfront are known to be correct, and we simply pick correct 60%, but in random fashion. So we don't know which ones, but we say 60%, and the rest again is random. So not saying that the rest is false, wrong prediction. In that sense, it's not 60% accuracy ratio, it's a bit higher because the rest also has positive hits in this context. So we end up with this data frame here, long, random, short, 10, 15%, 51 accuracy, upfront 60, 75, and 90. I'm not going higher because I don't need to for the numbers. Here, when I add now up the performance, we see that simply going long with euro US dollar is not like the best strategy in the world, so we would lose some 7 point something percent. Random, it's much, much better than long or short. It gives us here a 1.24, but over 5 years. This is not annualized, so it's a factor of 1.24, a total of cross performance of 24.5.6% if you round up. So now you see the others here, like factor of 12, factor of 23, factor of 18, 16. And here is also a bit of randomness included, right? So you see there's no guarantee here with the approach taken, given that I draw many things randomly, that one is necessarily better than that one, right? 75% upfront accuracy, 43, and here 90. That's by chance, right? Here the 90, factor of 90, that's here by chance. This is not planned, or we cannot derive any linear relationship, proportional relationship here. So factor of 90 over 5 years. Who has ever seen something like that? Nobody, I would say. Maybe some lucky speculator with, I don't know, highly leveraged products. And you see here the evolution, and this is what is at stake, right? If you would have an artificial financial intelligence who gets always the predictions right, always meaning 90% plus, here in my case, that's here, that one, then we have a factor of 90. So every euro, every dollar, every currency unit invested would bring after 5 years 90. So now go 5 years further, compounding would do magic, right? And we would be absolutely rich, what I was writing before. So when I get this out and say, well, this is by far not realistic, still the 75 here, factor of 40, we also can get out the 75, and we see here, like that one is still factor of 20, right? And down here, the flat line, or flat lines actually, these are the first three here, long, short, and random. And the rest here with the high accuracy gives us these values in this context, right? Would be fantastic. So, and since this is at stake, and people would like to achieve such stellar performance results, right? People have come up with different methods to predict markets, right? Usually people would say, well, I have trading strategy based on pattern X, Y, that. But the only thing that shall be accomplished is to predict with a high accuracy, high probability, the future direction of a market movement. So in that sense here, where we have another look at Wikipedia, stock market prediction is the act of trying to determine the future value of a company stock or another instrument. So we have boiled it down a bit to directional change, right? The successful prediction of a stock's future price could yield significant profit. So what is here pointed out in a few words, we have calculated before. What could it mean, significant profit? Yeah, we have seen the stellar performance on the previous chart. So the efficient market hypothesis suggests, on the other hand, that stock prices reflect all currently available information, and any price changes that are not based on newly revealed information thus are inherently unpredictable. Again, if markets are really efficient, we wouldn't have any business in trying to predict the unpredictable markets in that sense. So others disagree, and there are many people that disagree, right? And those with this viewpoint possess myriad methods and technologies which purportedly allow them to gain future price information. That's what we are after here, and written out on Wikipedia. So what methods have been used? And this is just like a small selection. There are probably quite a few more, but I think these are popular ones. Fundamental analysis, right? Value, growth, technical analysis, trends, support, breakout. This is what we all know because it's so visual. When we see pattern, I have a few graphics later on. Statistical methods based on regression, Bayesian models, time series modeling, right? ARIMA, for example, or of course these days, artificial intelligence, machine learning, deep learning, reinforcement learning, all stuff that we can apply more or less out of the box to the problem of predicting markets. So technical analysis methods are still pretty popular. Many people, thousands and thousands of people around the world use technical methods on a daily basis to trade. They are popular, they're in general easy to understand, intuitively appealing, and one of the most simple examples, an example that I use since years for teaching, is the use of two simple moving averages. So that's also an example, for example, in Python for algorithmic trading in my book, which comes first and which is discussed in detail. Because it's so simple, you can learn the Python techniques required to do backtesting quite a bit better than like focusing on a very involved strategy and then trying to learn the Python side as well. So 2 simple moving averages, here 42 days, 252 days, and usually the idea is that if the shorter one is above the longer one, then I would like to be long here in this context, and otherwise I would like to go short, or would go short according to the rule. There are more sophisticated strategies with like 3 moving averages or exponentially weighted moving averages, or sometimes the price itself, so no moving average in that sense, are used and combined. Here, just one of the many examples that we could come up with. And you see the strategy here visualized, right? So a long position here is +1. It's like this gray line here. This is a short position, long position. And you see here at every crossover, the position is changed. So blue is above purple, so we would be long. If blue is below purple, we would be short. And here you see a typical signal which yields significant profits, as we have seen before or read before. So here the crossover and the market drops significantly after. Significantly, we need to look here at the scale, right? It's euro US dollar in this context, but nevertheless, the market drops given this chart here, given the scaling significantly, and this would be, for example, a profitable trade. But that one here, right, another crossover, probably not, because the market is sideways trending here in this particular case. So that's one strategy. There are also even research papers and refereed and then primary journals out there who analyze these strategies. So it's not only something for the esoteric domain. Here we have for the first time now patterns, chart patterns from technical analysis, and this is from Reddit. And this chart, because it's simple, and I thought there are quite a few in there that many people know. Maybe some of you are trading, right? So, for example, here a bullish double bottom, right? Bearish triple top, right? But who should know whether it's like double or triple, whatever, right? Here head and shoulders, bullish inverted head and shoulders, right? That's the typical one, head and shoulders, here the head and shoulders, maybe arms we could interpret as well. And the basic idea is when you spot such a pattern, right, here the market is supposed to go down. But what you are not seeing here, A, for which instruments this works, and B, if it works, whatever this means, working, what is the probability for the market to go down? For sure, this is not like something that is certain, right? This is just like with a probability, but typically in these books about charts, technical analysis, you won't find probabilities in this context. It's just like they say, well, if you see this pattern head and shoulders, then the market goes down, you should go short. That's typically the point. So one of the prediction methods. And you see here the green parts, here the green arrows, this is the prediction. Here the market is supposed to go up. I wouldn't interpret this chart here that it goes up like to the very same level, but that it's going up. Maybe a little bit lower, maybe on the exact same level, maybe much higher, right? So in that sense, these are patterns that should predict a directional movement, upwards movement or downwards movement here in this context. So we have half upwards and half downwards here. So that's the basic idea, patterns, and when we spot such a pattern, the market is supposed to go up or down. So now correlation versus causation. In that sense, when we have a look here, so this is supposed to be causal. Usually when you read about this, right, causal, oh, this pattern causes the market to drop. Probably not. It's more like a correlation in a statistical sense, right? It might not be a perfect signal, this was my argument, but it might work on average, let's say 60% of the time, 65%. Just recently somebody wrote, oh well, I've checked this this signal and it seems to have an accuracy, predictability ratio here of 70%, just as one example. But in books, you usually don't find these numbers, just example, anecdotal example. So now correlation versus causation in a more formal context than our meetup groups in the context of the Python usage. Here I quickly show one stylized fact about financial markets, right? And we have in the set of stylized facts, and there are quite a few out there, we have quite a few that are with regard to a stable non-zero correlations over time. So one is that the S&P 500 and its volatility index, the VIX, are negatively correlated, highly negatively correlated. So highly negatively mean close to towards -1, for sure not +1. When the market goes up, maybe steadily, right, bullish environment, the volatility index typically goes down, and vice versa. When we see a crash, the market drops, volatility, the VIX spikes. And we see here the number -0.8. And see the plot here, right? Negative slope of the regression line. through here the log returns that are plotted here in a scatter diagram, right? So I was writing out before stable over time. Now you see it here over time. Before it was just cross-section over all the observational points. Here we have now a rolling correlation between the S&P and the VIX, and you see indeed over time we have a highly negative correlation. So the highest value that we see here is somewhat close to minus 0.7, and the lowest value is here, I think exactly minus 0.9, and that's actually the bandwidth within which over the last, not the last 10 years, over the 10 years here, or 9 years, because we need quite a bit of data, the correlation was given. So we could now say a wonderful stable correlation over time. When the market goes up, the VIX goes down. So we could now declare one of the two as a leading indicator and then try to trade based on S&P 500 options, let's say, or simply ETFs, or based on VIX futures, VIX options, for example, if the S&P is the leading indicator, and try to make some money out of this stable correlation, negative correlation over time, right? But it's not as simple. So when I go now here and define here the S&P 500 correlated with reds, this is like the standard correlation, right? Here 80, and here you see now over time, but with the VIX shifted by 1 day. So in this context now, this is for reference, in this context now we declare VIX to be the leading indicator. So when the VIX goes up, for example, we would go short the S&P 500. But over time, you see here basically the slope is 0, at least to 2 digits. The ordinate value is also close to 0, and the correlation here changes over time, but it's hovering around 0. So from the minus 0.8, we are now getting to a world close to 0. Right? So this does not work. So we cannot really use the VIX as a leading indicator. On the other hand, now let's change this here. So we have for the S&P as a leading indicator here, also overall close to 0 correlation, close to, and here we see it also over time. It changes over time a bit, but it's basically close to 0 throughout. At least not in absolute terms on the level from before. So maybe let's do here also the shift we have seen before, already calculated, right? So this is even closer to 0 than in the other context. That we also have the number now for comparison, 0.06 and for 0.01. Would be too nice if one of the two would be a leading indicator, but they are not. So a bit of finance history. I want to quickly go over that. So we've had the ancient period where people simply formed their opinions based on what was written in the newspapers, based on what others told them. So this was roughly until the beginning of the 50s. Then the classical period more or less started with the Markowitz model with regard to mean variance portfolio investing, where for the first time risk, return, correlation, covariance matrices, etc. Entered the scene. And this is basically covered in my book. So of course there are hundreds of other books, but of course here Python for Quant Finance is our group, and my book uses obviously Python to introduce these theoretical elements. The modern period is characterized by many different advances and breakthroughs with regard to theoretical models, but also, or in particular, you could say with regard to computational finance, right? Computers were suddenly available, and instead of just like pen and paper and doing mathematical considerations, you could also use now computers in order to do, for example, in order to, let's say, do Monte Carlo simulation or implement other numerical methods, etc. Right? So stochastic interest rates, stochastic volatility, right? In my book, Derivatives Analysis with Python, I cover quite a few of these advances and breakthroughs from that period. Now, the computational period, so we had breakthroughs in the decades before 2000, right? But I think really like from 2000 onwards, of course, this is a bit simplified. We saw a shift from the theoretical side of finance to a computational one, driven by advances in both hardware and software used in finance. And at the beginning of the, not really 2000s, but was for me like 2003 when we got started using Python, more or less as a side gig, as a hobby, right? And this has now turned into our profession, and for me also into my passion. And Python for Finance, I think, covers the wonderful ecosystem that we have in Python to do finance. And now artificial intelligence, of course, has entered the scene, and not only for, let's say, the Googles in the world or the recommender engines or the natural language processing success stories, right? We can apply this to finance as well. And AI first finance, term that I like to use, describes a shift from simple and general linear models in finance to the use of advanced models and algorithms from AI. So my book, AI in Finance, is probably the one that suits best this particular period. Yeah, this is where we're coming from, or where we are heading towards, right? Post 2020. AI is there. I think it's all still nascent, but there have been quite a few success stories in this regard. And here with regard to market prediction, I also want to use machine learning AI methods. But first, a brief review of what we are up against, right? In terms of efficient markets. Again, we have read the text already before. If markets are efficient, we shouldn't have any business in predicting markets. So here from one of the first papers to address this topic, random walks and stock market prices. So here this theory casts serious doubt on many other methods for describing and predicting stock price behavior. Methods that have considerable popularity outside the academic world, and maybe sometimes also inside. So for example, we shall see later in that paper, right, if the random walk theory is an accurate description of reality, then the various technical or chartist procedures, recall the couple of charts, right, head and shoulders, and so forth, all these procedures for predicting stock prices are completely without value. So no matter what we do, if markets are efficient, there shouldn't be any opportunity to make economic profit. So here is a bit more of a modern, so more than 10 years later, a bit more modern definition. A market is efficient with respect to an information set as, I like to think of the information set as maybe a huge data frame, pandas data frame object with lots and lots of data, maybe different types of data, whatever this might be, price data, news, sentiment, whatever, volume, you name it, fundamental data, whatever. If it is impossible to make economic profits by trading on the basis of information set as. So that's a slight difference. So we can have maybe a statistical edge. Right? We might discover statistical inefficiencies, but of course, if we want to make economic profits, we need a vehicle, and it's typically a trading strategy or an investment strategy that allows us to harness the power of our predictions in the form of alpha, let's say, right? Abnormal, quote unquote, profits, right? So we need a vehicle in order to do this. Just statistics, just machine learning usually is not enough. And of course, even retail investors, traders have all the options, all the capabilities these days with their notebooks, with their desktop computers, any kind of computer that you have bought in the last 5 years, let's say, to make it specific, is appropriate to develop, to do research, and to see even write code that you, for example, can deploy in the cloud and trade via APIs on different brokers. There's a question with regard to whether I don't know, maybe some others as well, are using interactive brokers for live algo trades. No, we ourselves are not using interactive brokers. We teach it, for example, in our programs, Python for algorithmic trading, right? But we are not using IB. I think, and most people who know me a little bit longer, that they have one of the worst setups in terms of API trading. Of course, they have a large product spectrum with regard to options, stocks, and other instruments that you can trade, but the API is all but modern that setup. So what we personally use, for example, with the machine is ONA, Wanda, a CFD broker, because we mostly focus on forex trading, and you can trade commodities, CFDs, and index CFDs, and other stuff there. With them, they have, I think, a wonderful and pretty powerful API for trading, which for smaller outfits like we are pretty good, right? So yeah, that's the trading side.
Also, Yves, can we just jump in here? There's another question saying that are the fees a big factor in the simulations you showed earlier? Probably.
Oh, well, I don't know if I have a comment there. Usually I say it at least. In the simulations, the backtesting example is pretty simple. I'm assuming no transaction costs whatsoever. So end of day, it's also not high frequency, not even mid frequency. If at all, there are daily rebalances, and even that might be more rare in this context. But with what I've shown, the results are excluding transaction costs. Of course, if you want to do this properly, the transaction costs are a big factor. Among others, I said before that we are mostly focused on FX, etc. You have, I think, some advantages, not only the technology side, but also the relatively low transaction costs and the symmetry in the market, right? With regard to stocks, if you want to short, etc., it's much more involved than to say, well, I'm trading Euro US dollar, highly liquid, and I can go long and short this particular market easily on the same side, fully symmetric. Right. Of course, there are many other platforms. I usually can't really comment on them because we are not going through the platforms. We focus ourselves in the program on the Python side of things. We cover 4 platforms: FXCM, ONA, Wanda, and Interactive Brokers, plus Gemini for crypto trading. And these are the only platforms that would be in a position to comment on. So here we have the different forms: weak form, semi-strong form, strong form, just for reference. I also have later on a code example, but I will skip that example. So Markov property of stock prices is consistent with the weak form of market efficiency. You recall I introduced Markov process, Markovian processes, right? This states that the present price of a stock impounds all the information contained in a record of past prices. If the weak form of market efficiency were not true, technical analysts could make above average returns by interpreting charts of the past history of stock prices. There is very little evidence, maybe not, I don't know, that they are in fact able to do this. Yeah, and in that sense here now try to do some operational implementation to test efficient markets, but again, I'm not going through these in detail. You have access to my slide deck where you maybe can dig a bit deeper. So let's assume efficient markets are true. Then what are you supposed to do? Yeah, maybe you turn to passive investing and index funds. And here I have one article which I found pretty interesting. Also, I like the title, "The Theory of Almost Everything for Financial Markets," Financial Times, end of 2020. It is true that the indices that passive funds track have over time morphed from being supposedly neutral snapshots of markets into something that actually exerts power over them, thanks to the growth of passive investing. So the one thing is that you say, well, markets are efficient, check. So you might not share that opinion, but let's say it is the case. What do you do? Passive investing. But the more people believe in efficient markets, the more people do passive investing, the more efficient markets become, because they behave exactly then in a way that the EMH or in Walk hypothesis would predict. So here Mr. Green argues that this helps explain why active managers are actually seeing their performance worsen as passive investing grows. So the harder we try, right, to outperform the market, maybe the worse it gets, because when passive investment is growing and exerting more and more influence, then, yeah, as we have read before and see here, again expressed, this might be not a good way of managing your money. The more money index fund managers garner, the better their holdings do in exact proportion to their weighting, and the harder it is for traditional discretionary investors to keep up. Basically, self-fulfilling prophecy in that sense, right? Self-reinforcing elements in the market. So the more is invested into passive funds, and you see here the growth, right, of the index fund universe. It's beyond the 12 trillion mark US dollar here. So this is growing. Here a little dip in 08 crisis, right? Maybe some outflows here, a tiny dip 2018, but overall, of course, if we would have some regression line here, some smoothing line, that's growing from some 2 trillion 12 years ago to 12 trillion. Lots of cash getting into ETFs and index funds there. So in that sense, markets per se don't need to be that efficient necessarily. If enough people behave that way, it becomes indeed a self-fulfilling prophecy. That's my take on that. So mathematics and science, so finance has been characterized by math since the 50s, right? Markowitz, mean variance portfolio theory, the first quant model, as I like to call it. And in other disciplines, and this is a very interesting book, I must say, I've listened to it. I have it also in print, Lost in Math, by Sabine Hossenfelder, How Beauty Leads Physics Astray. They were so sure they bet billions on it. For decades, physicists told us they knew where the next discoveries were waiting. The experiments didn't reveal anything new. So Large Hadron Collider, physicists have found many things that were predicted by theory, but some of the theories are simply theories, right? What failed physicists, here another quote, wasn't their math, it was their choice of math. They believed that Mother Nature was elegant, simple, and kind about providing clues, and here we could replace, they believed that the financial markets were elegant, simple, and kind about providing clues, right? But maybe it's not the case. They thought they could hear her whisper when they were talking to themselves. Now nature spoke, and she said nothing, loud and clear. Even in physics, which is usually mentioned as the scientific discipline where math is doing so much good, right? The whole world seems to be like a mathematical construct. But there are issues, right? In particular with regard to the grand unified theories, they are often elegant, but they have hardly any predictive power about the reality, and that's in finance as well. So, for example, as one of the examples, I'm a big fan of classical theory, so don't get me wrong here. So my latest book is only about classical theory, for example, the capital asset pricing model. But for example, in AI and finance, I argued that all these models are mostly useless. And you see it here also, pointed out by people who are much more renowned than I myself, right? Farmer French, 2004, not yesterday, already like 17 years ago. The attraction of the CAPM is that it offers powerful and intuitively pleasing predictions about how to measure risk and the relation between expected return and risk. Unfortunately, the empirical record of the model is poor. But where is the point in having an elegant theory which doesn't do any good in reality? So poor enough to invalidate the way it is used in applications. The CAPM's empirical problems may reflect theoretical failings, a result of many simplifying assumptions, but they may also be caused by difficulties in implementing valid tests of the model. But just think of maybe some other context, let's say a navigational system in your car. What would be the worth of such a navigational system if only 50% of the time you would reach your destination? And also here, if you have with such a simple model already the problem of implementing valid tests. I mean, if you want to test a navigational system, that's pretty easy, right? You are at point A, you want to get to point B, and then you check whether it leads you in a proper way, which means fast and in short distance, right, to point B. But here, even the problem to properly test it, right? The version of the CAP-M, that's a conclusion. The one is here from the introduction, the other one is from the conclusion of the CAP-M developed by Sharp and Lindner has never been an empirical success. The problems are serious enough to invalidate most applications of the CAP-M. Yeah, that's the problem with math. CAP-M, wonderful linear model. We have the two major assumptions which characterized finance over decades, we can say. Linear relationship and normally distributed returns. These are the two major assumptions. And they are typically not given in reality. No normal returns, as we know, neither linear relationships in general. What is to the rescue? Yeah, we have lots and lots of data. And again, thanks to Jason and to Refinitiv for co-hosting and supporting our event and our group since years, actually. And Refinitiv provides tons of data which you can use instead of simple models. Here from the unreasonable effectiveness of data, a much and widely cited article which has its title somehow derived from the unreasonable effectiveness of mathematics in the natural sciences. We have seen, yeah, it might be effective, but modern physics might nevertheless suffer from what is called the beauty myth in this context. Right? In this article examines why so much of physics can be neatly explained with simple mathematical formulas, such as F equals m times a, so mass times acceleration, or E, energy is mass, the mass times the speed of light squared. So meanwhile, sciences that involve human beings rather than elementary particles have proven more resistant to elegant mathematics. And what is economics? What is finance about? It is, of course, about how markets behave, driven by people who act, who interact in the markets, right? Economists suffer from physics envy over their inability to neatly model human behavior. So economists and financial theorists have over decades tried to come up with nice equations like the capital asset pricing model, right? Or others in this context. It's just the one example that we have covered before, but there are many, many more. But maybe finance, economics might be closer to language than it is to physics. So an informal, incomplete grammar of the English language runs over 1,700 pages. Perhaps when it comes to natural language processing in related fields, we are doomed to complex theories or maybe complex models. Think of a deep neural network, many, many layers, many, many hidden units, etc., right? That will never have the elegance of physics equations. So, but if that's so, we should stop acting as if our goal is to author extremely elegant theories and instead embrace complexity and make use of the best ally we have, the unreasonable effectiveness of data. So we have data available, APIs, we have the data providers, we can digest tons of data, even with our regular machines, notebooks, modern desktop computers, we can crunch tons and tons of data points. And once we have done so, by the use of Python and related technologies, packages, we might then apply artificial intelligence. And here, I'm not going into the details, but this is my equation. This is what I understand under AI First Finance. Big financial data plus artificial intelligence makes for AI First Finance instead of theoretical or econometrically driven finance approaches. Right? In my book, many more details. Here, I rather want to quickly go through very simplistic applications. And when I was saying in the beginning, I'm not providing an answer, it's more like a framework. I want to pick up my approach introduced at the beginning with regard to the predictability and the 32 patterns and what we understand in this context. And let's see how it works. So first we assume, and that's like an implicit assumption, so hardly ever this is pointed out, we assume here that there are patterns, persistent patterns in financial markets that, when identified, allow to predict future price movements, up or down. To simplify things, we assume binary features and labels only. So as before, this is what we have done during the definition phase, the first agenda point there, predictability defined, where we say up or down. And when we have 5 historical directional changes, we have 32 patterns, 2 to the power of 5. Right? So here, code for you to reference if you like. But I create here features and I do some lagging. Right? Lags, 5 lags means we have 5 binary features, and labels data is also binary. And here in this context, we now have a simple classification problem, as pointed out earlier, which we can train, for which we can train appropriate models through supervised learning. Now let's do some simple checking first. 2 lags only. This is just 4 patterns. For sure, we can process this in our head, but let's have a look at frequentist approach here. And frequentist in a sense that here I go only with my binary labels and 2 binary features. And binary here, I said it before, not 0, 1, but -1, +1, so that we have really the idea of market goes down, -1, market goes up, +1. I think it's a little bit, for me it's more intuitive than the 1, 0, but they are here basically the same. So I divide the data into training and simple test data. I now use a simple frequentist approach to the prediction problem. And by frequentist, I mean the following. So I skip over the code. I simply do some counting and derive here my perks, relative frequency for upward movement. Meaning here in this chart, when I increase this, -1, -1, this is one pattern, right? Downwards movement, another downwards movement. Here's downwards movement, upwards movement. But let's start here, 2 downwards movements. After such 2 downwards movements have been observed, afterwards, we saw in our data set 212 downwards movements and 237 upwards movements. So the probability, the frequentist approach here to our probability estimate is 52%. So here we would say, well, it's more likely that the market goes up when this pattern is observed than down. And here even more so. When we see -1, +1, we have a 54% probability given our simplistic approach here for the market to go up. So this is has nothing to do with machine learning. It's just like the same data actually, 2 lags and 1 label, sure, right? 3 columns in my data frame, and I have done simply some counting in this context. Now let's go with more patterns, like 5 lags, now 32, exactly the same as before during the definition train test. Right, where we now use, for example, decision tree classifier, very simple thing here, easy and fast, absolutely efficient to apply, maximum depths of 3, right? We fit the model, we check here the accuracy score on the training data set, in sample 55%, but out of sample 48%. So that's not good. We would say in sample, yeah, it's nice, but if we want to do some trading here, we of course need a good out of sample test data accuracy. Another approach, the same code basically, but another approach. Here now a support vector machine model, also here applicable for the supervised classification problem. Accuracy score in sample a little bit better, but out of sample a little bit worse than the other one. So the final one, when they say, well, they are all so simplistic, let's use maybe some deep neural network. Here is a multi-layer perceptron classifier from Scikit-Learn. Same approach, we train it on the train data, some 80% of the data set. We then check here the accuracy in sample, 55% out of sample, even worse. Again, I'm not here in the business. I could come up with examples where I show you some, I don't know, 60% if I snoop my data here long enough, if I play around with. Again, this is just a framework, right? When we have a machine learning perspective, instead of head and shoulders patterns or simple moving averages, exponentially weighted moving averages, we would come up with a numerical representation in the form of features of patterns, right? And we then have like a bunch of different classification models that we can simply apply. That's the message here. I'm not in the business of answering finally the question. That's work in progress. That's the framework for that discussion as it currently stands. But we could conclude, given our very simple examples, but the data alone is too simplistic here. It's simple, but it's also too simplistic in this context in order to read too much into the results that we see. So, last but not least, conclusions. Being able to predict financial markets prices is the holy grail in finance, right? We can get immensely rich if we do this well. Financial practitioners and academics have tried many different methods in the past to predict markets. So there's so many people out there, they simply refute the efficient market hypothesis, maybe without evidence, but they say, well, let's try to overcome the curse of efficient markets. Right? While there seem to be a number of persistent correlations in the markets, causal relationships are hard to identify and or to exploit. The EMH has seen strong empirical support in the past. The EMH basically says that the markets are not, or that the markets are not predictable. While mathematics and normative ideas dominated finance in the past, right? Usually financial theory says, well, let's assume people behave in the way ABC, or if people are rational, they should do X, Y, Z, right? Normative. Finance has become a data-driven discipline with many emerging AI applications. So AI, machine learning, deep learning might open a path to identify and exploit statistical and economical inefficiencies in the financial markets. Yeah, that brings me to the end of my talk. And if there are questions, you can ask them now so that I can answer them for everybody. Otherwise, as you might have seen on the agenda, we will have time left to meet in the virtual rooms. The number of people that can get to the rooms is limited. So in that sense, you might also meet like-minded people and discuss in different rooms different topics there, for example, right? But if there are questions right now, I can answer them here for everybody. Otherwise, given the time, we might then move and reconvene in the meeting rooms.
So we have a question here from Iraj, who says, thank you for the presentation. Financial markets are dynamic and time varying, but in machine learning and other approaches, we assume our system is time invariant and patterns can be taken over time. How can we deal with this? Should we use dynamic machine learning structures?
Yeah, the way I have presented the problem here is indeed a static one, and I have written it out in the one slide where say let's assume that there are stable patterns over time. But of course, and I think that's the beauty of machine learning and data-driven finance, that as soon as we get new data, we can include the new data, right? The cap M is the cap M, no matter whether we are in the 70s, 80s, 90s, 2000s, or now in the 2010s and 20s, right? So that's the assumption of basically all the theories, right? There's a proof and it's derived on a set of assumptions which might hold to some extent or not hold at all, and the theory is supposed to hold. But with data-driven AI first finance, we are not relying on these static approaches, theories, right? Where we say, well, that's supposed to be the truth. So we can say, let's add data to the story as we see it. So as one example, just like an operational example, here in my approach, I have a fixed data set. I take 80% for training, 20% for testing. I could take 70% and 30% or whatever, right? But what I could also do, and this is also easy, straightforward to implement, is that I say, well, let's take the first year worth of data and predict only the next day. Then at this day, like in the real life trading, right? At this day, so enlarge the data set, retrain the model and predict the next day. So you could go day by day and include step by step what is now known, which wasn't known the day before. And this, of course, is in sharp and complete contrast to how finance was done in the past, right? People were writing and publishing papers, and that was supposed to be the truth. In physics, it often is, right? If we have gravity on Earth, which is measured, right? We would say, well, when I measure this 2 years from now, it should be the same value of 9.81 as the number G, right? That's in physics. In finance, as with language, therefore, I think is a good analogy. Language is also living, maybe not as fast or changing in as fast a way as finance, so on a daily basis, but still, language changes. The language of the 80s is different than the language of today. We have new words, etc., and this is what natural language processing must also deal with. There's somebody asking with regard to different indicators. Of course, I have here, I think, the most simple setup with regard to predictability as I defined it and the application. Just directional changes, 5 historical lags, most simple setup I could think of, right? But of course, instead of just directional changes, we could go with absolute prices as features. We could go with, my example, simple moving averages. We could use any other indicator like RSI, MACD, or Bollinger Band values. We could include everything that we have in technical analysis just in the form of numbers and not in the form of charts, right, into our analysis. That's easy to do. You have done a data frame, maybe not with 5 binary features. You might have 25, maybe even 200 different types of features, real valued features in this context.
And in fact, I'll just jump in here and say that there are 2 libraries that you don't have to code each of the indicators yourself. You can use TAlib, which will give you some technical indicators, or indeed, I think TS-Fresh did a good job of kind of creating all sorts of
Absolutely.
derivatives from all sorts of derived features from single series.
Yeah.
So there are more libraries to help you do that. I think the only thing you need to be cognizant of is the correlation between those features.
Yeah, of course. TS-Fresh is a good point. So you get for free out of the box, so to say, with a single command, like 300 plus minus features, depending on the configuration. And then you can also use approaches like select k-best from Scikit-Learn to select, let's say, the 50 most important ones. So sorting out highly correlated features, etc. Yeah. There are like more or less at least semi-automated approaches in order to exactly accomplish this. Right.
We have a question here. What is, I think somebody's trying to find maybe the New York group. So the New York Meetup group is called Artificial Intelligence in Finance and Algorithmic Trading.
And we can share the link to it.
Yeah, we can share the links of all the groups.
Yep. Wonderful. I think then it's a good time to stop this session, and even when, so to say, the session ends and you are quote unquote kicked out here, you can then enter the meeting rooms and can discuss with like-minded people. If you want to use video, audio, you can do all that, right? So happy networking, and the link to the slides was shared. It's currently pinned. If you have questions, also feel free to reach out via email or via webpage of us or to Refinitiv via Jason. So we're always there to help to answer questions. All right, let's then move to the networking groups, and this will then be, I would say, an open end, quote unquote. Jason, I think we won't have or do we have a final session? Yeah, we have planned for it, right? Like maybe in 20 minutes or something. That we then have some.
Let's be reasonably fluid about it. See how it goes.
Exactly. So, if there is a session, you will see it automatically. Otherwise, have a good time chatting with others.